Macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen. Caution seems to be the new watchword for our raging bull and market timer Kevin Cook. He's here with me now to elaborate further. Maybe I should say one-time raging bull. I mean, what's going on here?
No, still a bull.
Has the flu gotten to you?
Still a bull. We just, I just want to make today about some caution, and so we're going to look at a couple of things.
Okay.
Here is a look at the S&P 500 since the November lows around 1340,
Okay.
and here we are fighting with 1510. What you'll notice is that the market is starting to have bigger ranges, and I've sort of drawn this expanding wedge. Some people call it a megaphone or a broadening wedge, and what that indicates is more volatility. Now, the volatility is relatively low, so that's fine. But this is typically a pattern you see at some sort of top. Now, I don't think it's the top, but this could be a short-term top where the market is digesting here and there's distribution among institutions. Some do some heavy selling, market goes back up, then you see some more heavy selling again. So earlier in the week I said we're going to see a range here between 1475 and 1515 on the S&P. We haven't been through 1515 yet. We could still get there because my first target for this leg was 1520, 1525. We may see that today. The market went down to 1505, and now it's going to try for the highs again above 1510. Mm-hmm. But this is just something to take note of. This broadening wedge and this increased volatility usually is indicative of institutional distribution in a stock. So I've sort of shifted from this bull market is innocent until proven guilty to in the short term, it's guilty until proven innocent. So
that says something too.
Yeah. Now, and here's another way of looking at it longer term. This is a couple of trend lines drawn from the 2011 tops right before the big drop off in August. And we're bumping into that area of resistance. So this is something that, the stocks have run a bit, so they're overbought by many measures, many technical measures, and now we're up against resistance. So a lot of people want to pull back. Maybe it'll come when they least expect it. They think, well, we buy every time it dips to 1,500, but really maybe we need to go to 1,475. We'll see. I'd be prepared to get much more longer than I am the equity markets on a pullback to 1475 because I still see 1550 as my target for the S&P this quarter.
So to clarify, your caution is purely based on technicals.
Oh, not so fast. So I also listened to our resident caution expert, Shiraz Mian, who is our expert on the earnings picture. Right. Nobody does a better job than breaking down the earnings, and you chat with them, I think, about once a week in his earnings preview, his earnings outlook, summary, outlook. He has several different views of it, and he uses his earnings scorecard, which he breaks down and is starting to show more. And that proprietary model, really gives him the big picture view. So I want to show a chart that sort of expresses what Shiraz is looking at every week. What does he keep talking about? He keeps talking about declining revenue growth, declining margin growth, and that equity prices cannot sustain these levels when you have declines in margins and revenue, even if the EPS growth is there or appears to be there. So this is not this is a chart I got from another financial analyst, but it basically expresses what Shiraz is talking about. And we could just focus on the right side of the chart since the third quarter of 2010 into the third quarter of 2012. There's the declining margin and revenue growth picture. So I think that stands out pretty clear. And so again, for the details on this, you want to listen to Shiraz, either read them or watch his interviews with you every week. Here's another standout thing, and I think Shiraz talks about this too. Where are the earnings coming from? According to this, 88% of 2012's entire S&P 500 EPS came from 10 companies. And you look at them, Apple, a lot of financials, Bank of America, AIG, Goldman, Wells Fargo, JP Morgan, Citi. That's been the strongest sector, the financials. Why? Because that's where they finally found escape velocity on their earnings, and they really launched.
Yeah, they seem to be driving this current season as well.
Yeah, so this is another thing that you want to pay attention to, and we can talk. I'm not even getting into the GDP picture here, but I just want to mention Eaton reported earnings this week, and the CEO Sandy Cutler was very outspoken in one interview that he did, that he thinks that China's GDP for 2012 was way overstated. He thinks it may have been overstated by as much as 3 to 4 percentage points. So can you imagine if we'd gotten word from China, that proof that the hard landing was really happening with a 4% GDP print? I mean, our markets would have been much lower. It might have caused a self-fulfilling recession here on the fear. And it's almost an example of what you don't know can't hurt you, or what you don't know doesn't hurt you. But we use GDP forecasts domestically and globally to make earnings estimates.
Okay, but you often talk about the S&P 500 being on its way to record earnings above $105.
Yeah.
As justification for the new highs.
Yes.
So are you changing this view?
Well, I don't make the earnings estimates. It's all the analysts, and we aggregate them, and we find out, where is the analyst community at? Are they at $110 for 2013, and are they destined to come down? That's the basic picture. How much they come down is the key. Remember last summer, I looked at Adam Parker from Morgan Stanley. He said 2013 would come in at $99. I don't think that's going to happen. I still think that we'll probably see some earnings growth and maybe $105 for 2013. But here's a longer-term view since 1995. The blue lines are the earnings estimates for every given year. And you notice, what do? They start out high and they come down low, down, 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 down. And occasionally, like 06 was a very nice year where the estimates kept going up. 05 also. But a lot of years there, estimates start up here, and they tend to come down over a 12 to 18-month period. Let me zoom in on this same chart so you can see. So this is just the look at 13 and 14. There's the trend. Estimates for 2013, probably middle of last year, were $126 for the S&P. Now they're coming down to already below, well, not below 110 yet, but say 111. But destined to come down below 110. 2014 the same way. Estimates are up at $130 for the S&P, destined to come down. So this is part of the picture, and the psychology is, we can trade on forward estimates, and the market will, especially once you remove all the obstacles. Europe's stable, China's growing again, U.S. policy is out of the way, no recession. So money managers have this freedom to get fully invested, and they'll do so on those forward earnings estimates. But we have to watch them. The reason I think that we can still ramp to new highs here in the S&P, possibly 1,600 this year, is because of the psychological component. Money managers have sort of a mandate to outperform the S&P, and to do that, they have to be fully invested. Well, if everybody else is buying stocks, I have to buy them too, to outperform the market. So it's that kind of psychology dynamic that even if earnings are only $105 for the S&P this year, it's still a record, and everybody else is buying stocks, so I better too. And that's why I think the dips will be bought aggressively still.
Okay, so bottom line, you're cautiously bullish.
Absolutely. Cautious in the short term. I should just say that's a short-term thing. You want to pay attention to it, and you have to watch the earnings outlooks, right? So we go down to 1475. I'm a bigger buyer, but I'm also listening to Shiraz about what's happening with the estimates in the aggregate, because that could sort of change the picture.
All right, so market timer Kevin Cook. Follow his articles on Zacks.com. You can generally link to them right off the homepage when you just go to Zacks.com. With Kevin, I'm Terry Ruffalo.